What are the main risks associated with hard money loans? Hard money can be a powerful tool, but if you don't understand the risks, it can wipe out your profit fast. I've seen smart investors get burned by hard money loans because they didn't see the traps coming. In this video, I'm going to show you the most common risks that flippers make with hard money and how to avoid them. In this video, you're going to learn exactly how to use hard money loans the smart way without falling into the traps that sink most first-time home flippers. So hard money loans. Well, first off, it's no longer the way it was back in the 70s and 80s with Guido the Killer Pimp. This is actually a group of people that have gotten together and they've pooled their money to invest in a higher asset class, which is house flippers. They're taking a risk that banks don't want to take. It's a short-term loan. But let's talk about the first thing, and that's interest. People sometimes get freaked out when they hear that interest rates can be anywhere from 9 to maybe 18%, or maybe even more sometimes, for hard money loans. And it requires points on the money. Now, let's be clear about exactly what that money means. Number one, it's a short-term interest rate. Matter of fact, it's designed for a one-year loan maximum usually. So, for easy math, if it's a 10% loan and the amount you borrow is $100,000, if you used it for the full year, you're going to pay $10,000 in interest for that same time. Now, if you use that money for 6 months, you'd pay 50% of that, half of that, or $5,000 in interest. You pay for the time that you used in most cases. There are some minimum times, so be careful of that when you're applying for a hard money loan. But just understand it's a short-term loan. It is a means for you to get to profit. You can't compare it with interest rates that you see at a traditional bank for long-term amortized mortgages like a 20 or a 30-year mortgage at 5%, 6%. It's not comparing apples to apples because this is a very short-term, simple interest loan. Now, I mentioned points before. A point, 1 point, equals 1% of the total loan that you've taken out. So again, for easy math, if you borrow $100,000, 1% would be the fee or $1,000 that they would get for initiating that loan. Usually points are between 2 to 3 or 4 points. I've seen them as high as 7 and 8 points. It just depends on the lender and also depends on your credit. Usually in this scenario, you will make monthly interest payments to the hard money lender. So interest only payments. So again, for easy math, if you were supposed to pay, let's say 12% on a $100,000 loan, so your total for the year would be $12,000. You'd pay $1,000 a month until you were able to sell that house, and at that time you pay off the principal and any remaining interest left. If you're required to pay monthly interest payments, make sure that you budget that out in your monthly cash flow so you have enough cash to get you through the flip. That's important. Okay, let's talk about some of the risks that come along with it now that we've defined what hard money is and how that looks in your business. So some of the risks are, I mentioned before, there might be a time frame minimum on the loan. In other words, they may say, we'll loan you this money for up to a year, but we're going to require a 6-month minimum on top of the regular points and interest, which means even if you flip the house and sell it in 4 months, you're still going to pay 6 months of interest. So it's important to understand those terms going in on a hard money loan. Now, the other scenario might happen as well. Let's say it's a 12-month loan, and let's say that your project goes into the 13th month, the 14th month, and so on. What's going to happen? Well, the lender certainly has the option to foreclose. However, they are not in the real estate owning business. They really don't want to own your property. So usually they'll extend the terms, but usually they're pretty stiff penalties. It might cost you a few points on the mortgage, and they may up the interest rate and give you a short term. So these are pressures that start to come along with flipping a house when you're using hard money if you haven't managed it correctly and it goes over the timeline. So you may ask, do I have to personally guarantee that loan? And I'm going to say almost always yes. And do they may want some other collateral if you don't have the best credit? Yes. They might want a piece of your home. They might want a piece of another rental property or a piece of a retirement account that you have as a backup collateral in case you default on the loan. Remember, they're taking a risk on you that you would know what you're doing to flip that house and get out of it. Now, the more experience you have, the less collateral you'll have to put up and the more you can just use your signature. But you will probably always have to sign personally on top of your corporation signing for that hard money loan. So here's a risk. What if your project drags on and you think you can't sell that house? Well, number one, I'll tell you that every house can be sold at the right price point. If by some chance you made a huge mistake and didn't pick out the correct ARV. I'd be really surprised if the hard money lender didn't do their own homework, because they always do in underwriting, to make sure that you had a good ARV. But if for some reason you were both off, the hard money lenders do not want to foreclose on that property. So I would renegotiate with them. One of the worst things you can do is ignore them. If you ignore them, they get scared that you've jumped ship and they will foreclose on that property and whatever collateral that you've put up as protection against it. So just make sure you keep an open line of communication and talk through whatever problems you're having, because at the end of the day, they want to know they have a repeat customer they can loan money to, that even if you find challenges, that you make sure that you can sell that property. Now, you might have to turn it into a rental. That's happened to me. I've had a property that we had a very difficult situation. We got way over leveraged on it, and I decided instead of selling the property, I could have broke even, but I wanted to make a profit. I decided that to pay off my hard money lender, it made more sense to refinance it and turn it into a short-term rental. So that's what I did. And then 5 years later, I sold that house for a $100,000 profit because it had appreciated that much in 5 years. So sometimes you can refinance to pay off the hard money lender as well. You have a lot of options in real estate. Just make sure you communicate with them all through the process. All right, let's talk more about cash flow needs. So usually a hard money lender will loan you 70 to 80% of the purchase price and then 80 to 100% of the renovation cost. But there are some unexpected costs and risks that you have to prepare for from a cash flow perspective. Number one, you'll have to pay for renovations upfront, material and labor, unless you can talk your contractor into holding out until your draw payment comes, and some will. But you're gonna have to front that money up front. Then they send out an inspector at your expense, anywhere from $200 to $400, to inspect the property. They send pictures back to the hard money lender. Once they approve, they'll then release those funds to you. You can then pay your contractor. So it's a little bit of a cash flow that you have to prepare for there. So here's how you can reduce your risk. Number one, have a clear plan. Number two, have a clear exit strategy and have flawless execution. Now, you're not going to have flawless execution if you're brand new, but the closer you can get to flawless execution, the better off you're going to be at getting that project to run through as fast as humanly possible and show the hard money lender that you're a serious real estate investor. If you do this right, you'll have an endless supply of money for your real estate investing business. So hard money can be really powerful, but only if you use it on the right property. I have put together a training to teach you how to buy what's called your buy box. So instead of focusing on all the houses that are out there, you can narrow down your search to the best one for you so you can make the most money in the shortest amount of time. Do me a favor, click on the link below here in the description and watch that training for free. It's my gift to you.